I'm your host, Neil Borate. Should you beat FDs by investing in the EPF or Employees Provident Fund? The interest on EPF is 8.25% at present and tax-free. I want you to take 1 minute to figure out a similar or higher post-tax return from another instrument. Go. FD rates have been steadily dropping in India. The highest SBI rate for non-senior citizens is 6.45%. In HDFC Bank, it is 6.6%. You can get more by investing in small finance banks or smaller commercial banks. For example, it's 7.4% in CST Bank. Yes, there is such a bank. Now, there are also NBFCs in the mix. So, for example, Shriram Finance offers 8.4% for a 5-year FD, again for non-senior citizens, but that comes with risk. The 8.25% EPF return is at the higher end of the interest rate spectrum. Of course, you have to be a salaried employee, you have to be part of a company that is governed by the EPF Act. So keep this in mind while watching this video. Now let's talk about tax. So FDs are taxed at slab rate. This takes a bite out of your return. So a 7% FD will give you 5% post-tax return if you apply a 30% slab. Now, of course, for EPF tax-free nature, there are some conditions as well. So you have to complete at least 5 years of continuous service, and you have to be working in a company that is governed by the EPF. So if you leave work from that day onwards, your interest becomes taxable. How about safety? Well, banks can and do fail sometimes. Just think about the PMC bank crisis in Mumbai just a few years ago. Yes Bank also stopped withdrawals for some time in 2020. The insurance for bank FDs under the DICGC is capped at 5 lakhs a year. So you're only insured up to a certain amount. And as I said before, cooperative banks are known to have failed in the past. Now, the EPF, by contrast, is tightly regulated by the EPFO and is governed by the EPF Act 1952. So it's highly unlikely to default. The EPFO also maintains a high interest rate for its members at 8.25% compared to banks, which try to maximize their spread by lowering the FD rates and increasing the lending rates as much as they can. Now, apart from EPF, you can be an Enthu cutlet and contribute to VPF or Voluntary Provident Fund. So, in case of mandatory EPF, it's 12% of your basic salary matched by 12% from your employer. So, for example, if your basic is rupees 1 lakh, you will be contributing rupees 24,000 per month in the EPF. But again, if you're an Enthu cutlet, you can go up to 100% of your salary to VPF or Voluntary Provident Fund. So you can contribute another 76,000 rupees to the VPF apart from the 24,000 that I just mentioned. But do note that interest on the EPF contribution above 2.5 lakh from the employee is taxable. So there are limits to how much you can game the system. Now let's talk about withdrawal. So FD money can be withdrawn at any point, of course. Typically, you're charged a 1% penalty for breaking an FD. And if you do a sweep in FD also, the interest rate tends to be lower when you prematurely break the FD. But in case of EPF, the money can be withdrawn completely after 2 months of unemployment. One of the few joys of being unemployed. You can also make partial withdrawals for health or for home purchase or marriage, generally after 5 years of being an EPF member. EPF withdrawal is complicated. There are a large number of rejections for technical grounds. And this, of course, is the main risk and the pain point with EPF. I repeat, this is the main risk with EPF. But if you're willing to take this risk, EPF will give you more than most FD rates in India with very low risk.